Good evening, everyone, and welcome to the Corporate America series, Max 7 Scorecard. So, hosted by FPS Asset and powered by beyondMF. So, Magnificent 7 has driven one of the strongest wealth creation cycles in recent years. But the key question for investors today is what comes next? So, in this session, we'll discuss Max 7 earnings, AI opportunities, concentration risk, portfolio rebalancing, and whether India could emerge as an attractive opportunity beyond crowded trades. So, before we begin, I'm delighted to introduce our distinguished speakers today, Mr. Jia Balaji, who brings 20 years of experience into wealth, equity, fixed income, and fund managing. And along with him, joining Mr. Ganesh, who is the co founder and chief product officer of FES Assets. So, thank you, sir, for joining. I'll hand over the session to both of you. Thank you.
Hi, I'm audible, right, Srinidhi?
Yes, sir, you're audible.
Okay, I think thanks for all joining for a lovely Saturday evening. I think this is the first time whereas from FPS Assets, we are presenting Corporate America series. If you have been tracking me, we have been doing a Corporate India series for quite some and we thought, what better time than now, where we speak about corporate America, where SpaceX is about to get listed in a week's time. Then you're going to have Anthropic and so on and so forth, right? Which is all $1 trillion company coming for a listing. So I'm sure those who are listening from India or from any part of the world, very exciting times in terms of what is happening in AI, how investors have made money. So the whole idea about the Max 7, the big, or to say, one of the fantastic companies globally, right? These 7 company, how they have performed and about their operating numbers, about their guidance, all we are going to speak in next 45 minutes to 1 hour time between me and Mr. Ganesh, who heads the product and other vertical. And finally, we want to give a thought about how we are thinking about having made the money, right, in US. Clearly, it's been a significant rally as we speak. 1 year performance of a US market is approximately 30%. To put in context, on a 30-year way, S&P 500 has given close to 11% CAGR. Last 10 years, S&P 500 has given 15% CAGR. Last 1 year, S&P 500 has given close to 30%, right? It means as an investor, a lot of money has been made and it's actually made in the recent past. So we always believe once money is made, it's a very good question to ask, okay, what made us to make this money? How the corporates are performing. In this case, it's American corporate and how to think about from here on, right? So this is what we will touch upon in next 45 minutes. So the first thing is this setup, right? Where are we at this point in time? So there's a very interesting data from BlackRock in terms of on the left side, which is a PE multiple. Typically, US PE multiple for last 30, 40 years ranged between, I would say the lower points are 12, broadly between 16 to 20 is a mid-range. Anything between 20 to 24 is a peak range. So at this point in time, the market is trading close to 22 times given which day we are referring to. So it's a question about where is the starting point, and definitely the starting point is reasonably elevated, right? That's where we thought we will address on the corporate America. But what drove this performance is also, it's not about an euphoric rally, right? It's actually driven by fundamentals. So if you look at the recent quarterly numbers of S&P 500, very fantastic growth, I would say, with an earnings growth of 28%, with a revenue growth of 11%. So when the 11% revenue growth happens out of S&P 500, this is in the context in which the world GDP growth is close to 2 to 3%, right? So S&P 500 companies' revenue grew by a factor of 4. So that is phenomenal. That led to a very good, strong earnings growth of 28. And for the entire year of 2026, starting Jan till end, the estimates are close to 10.5% on the revenue growth and close to 22% of earnings. So I think 2026 is going to be a very strong year for corporate America in terms of the earnings growth. And as I told, the multiple, if you have to look at today, the multiple is trading between 21 and 22, vis-a-vis a 10-year average close to 19. So clearly, as an investor in the US, you know your earnings is doing good, but you're also paying a premium multiple. And this premium multiple is also coming out of a premium earnings, which I will share in subsequent slides. So having spoken about the starting point, let's think about how S&P 500 is structured. So basically, totally 503 companies are there in part of S&P. The aggregate market cap of S&P 500 company, right? It's a 67 to 68 billion dollar. This data is a couple of days back. Obviously, what a context in which yesterday US market fell sharply, broad indexes fell close to 4%. But this is a couple of days back data, month-end data with a $67 billion, which is a very trillion dollar, right? Which is a very large index. And if you have to look at top 10 weight, which is 39.3% is a top 10, the 10-year CAGR is 15% CAGR. As I told, price to earning multiple, this is on the trailing basis, it's close to 28 for S&P, and the dividend yield is 1%. And out of the top 10, you can see the names. The Max 7 is almost there. Alphabet has both C and A class. That's why two types it's come out. Otherwise, broadly, out of top 10, all the 8 is the Max 7 ideas. So first, we want to refer the S&P 500, which is a much broader index. And obviously, we want to narrow down to Max 7, which is what driving the growth. Even at S&P 500, the growth is phenomenal. But I would say the bulk of the growth is coming out of Max 7 or a tech sector. So if you have to look at the revenue growth for the ending March quarter, from a 4% growth, which was 2 years back on the revenue, close to 4 to 5, 4.8, on a very good base, this is a 7.5. I would say this is what giving the entire market a big thumbs up is corporate America is firing. That is what leading to market to sustain on a very multiple weeks. The revenue is not only growing, it is also followed by a EBITDA growth, which is 12% 2 years back. On the base of 12%, S&P 500 grew 20% roughly. On the base of 20, another 12. One thing is very clear. In all these three where I mentioned, you can clearly see the EBIT growth is much, much higher than the revenue growth, reflecting corporate America is not only growing its revenue, it's growing its revenue in a most profitable manner. That's where the operating numbers, which is at EBIT and the PAT level, growing faster than the revenue growth. If you double click and see how these revenues have come, where the estimates have been met, where the estimates have not been met, the biggest thing is the technology sector, consumer service, consumer staples, material, most of the company beat the expectation, clearly reflecting, I think they are surpassing their own guidance, which they have communicated. And if you have to look at even the earnings, this is revenue estimates. Earnings estimate, interestingly, when I looked at the data, 97% of the company beat the expectation, 3% of the company met the expectation, and there is 0% of the company in technology has not disappointed, clearly reflecting the Max 7's performance is reflecting in the sector. And it is not only this sector, right? If you see broadly, most of the corporate in US, at least on the current last few quarters, has been doing extremely well than what the past is. So having seen where the starting point, having seen the context of the S&P 500, how the revenue growth has come, how subsectors have been doing. Now, one of the things which as an investor in US market, you should be aware, revenue growth to profit growth is significantly higher, right? Which I told. And I want to demonstrate with some data. If you have to look at the average margin of S&P 500 today is close to 14.8%, which itself is significantly higher, which has grown from 12.8 to 14.8. A 200 basis solid uptick in margin. What it means is currently corporate America is able to charge, get the premium and get the productivity. It also means your profit is a function of revenue into net margin. And when the net margin is very high, right? From here, one of the questions you should ask as an investor, can this net margin from 14.8 can go to 18, or a 14.8 can be at 14.8, or at some point in time due to mean revision, due to cost pressure of this war, can this 14.8 come to 12.8? If the answer is either 14.8 or 12.8, which is no expansion or a slight decrease in net margin, then the only lever of growth will be sales. This is where it's very interesting as an investor. How PE ratio at times can be misleading is when you have a corporate America is at a peak margin or closer to peak margin, the P is actually little more higher than what it is stated because of excess margin, you have excess profit. Because of excess profit, you have a depressed PE multiple, right? So that's a context in which, and the biggest sector which drove the margin is information technology, which has gone from 25.5% close to 30%. Roughly, I would say a 5% uptick in the margin, which is very significant because the bulk of the Max 7 is close to 33% of the S&P 500. When the big company expanded the margin, it took the entire segment. So that is where, as an investor, P ratios are slightly, I would say, inflated. It means it has to be a little more higher than what we are currently seeing. Very interestingly, consumer staple value margins are much lower. So this is something which, being part of an Indian investing community, we clearly see consumer staples used to have a very high margin. But surprisingly, when we looked at S&P 500 consumer staple bucket, it's close to 6%, right? So, but on a healthy S&P 500 totally is close to 15. So one of the questions keep coming about American corporates are doing well, but America GDP is 3%. So as an investor, what we tend to miss out is the corporates are listed in America, doing business all over the world. I think there is no better data than this picture, right? This has come from FactSet, thanks to them. If you have to look at S&P 500, close to 60% of the revenue comes from US, but balance 40 or precisely 41% of the S&P 500 numbers are coming from non-US, right? Clearly reflecting these are global corporates doing business all over the world, but part of listed in US and part of US. So these are global great giant company, I would say, right? And obviously, if you have to see by sector, as usual, utility, which is more of a domestic oriented, 98% is all about domestic. Vis-a-vis technology, more than 50% of the technology business is outside the US. So that is where Max 7 is a play of world GDP, world cash flow, efficient company listed out of America doing better business. I think that's how we see Max 7, predominantly bulk of the Max 7 companies. And to end the S&P story, I think if you have to see about the earnings, it generally doesn't be linear. And again, a very good data from FactSet where we saw 2 years of uptake, 2 years of a flat, slight downtake, uptake, flat, now up. And 26 and 27, the estimates are pretty reasonable, right? So as an investor, you know already there is an up journey, and this both the numbers are also reasonably penciled in. Markets is already a forward looking between 12 to 18 month, right? The question to be asked is, it's not about 27 earnings is growing. The question to ask is, what happens after this 28, 29, 30? Is it expected to go at 440, 500, 550, or is it expected to have a flattening? And this is where the past data will reflect. Post a big expansion of earnings, typically you will see a year or two of a consolidation, because that's how the corporate breathes, reinvest into new technology, new infrastructure, and get the growth up. So again, as the same point I was referring, PE multiple is a function of current earnings and what has been discounted. I think clearly, if you have invested in US markets, either in S&P 500 or anywhere, the current earnings is reasonably, I would say, taken a lot of good benefit out of this upcycle. So having spoken about the context and the S&P 500, now let's get into the subject of Max 7, right? This is the most, I would say, one of the greatest company which the world has produced. And if you have to look at the aggregate growth, and if you see Max 7 growth is 30%, right? Significantly better. And every single Max 7 company had a growth more than 10%. I would say having a double-digit growth in a world which is growing 3%, and these are global company, a phenomenal achievement. And I don't think the one of the greatest stock which we are so very aspired to see is the NVIDIA, which grew on a very billion-dollar business from 85% on a sales growth and the profit growth of 200%. So the sales growth is 30%, but if you have to look at the PAT growth, 80%. This is where the powering is happening, but you also have to remember all this growth is in the base. It means once this base becomes larger, the question is how long these companies can grow at this rate is the million-dollar question which we need to ask now. So having spoken about the S&P 500 and the Max 7, right? Now, next four companies of Max 7, I will be discussing on what is the commentary, what is the operational results, and then I will pass it over to Mr. Ganesh. So NVIDIA, one of the largest company, or the largest company, $5.4 trillion. When, as we saw, surprisingly, the beta of the company is 2.24, reflecting how sensitive this company towards the market volatility. ROE is insane, obviously, because of they are in a super upcycle. So they're making a lot more money than I would think always, right? But what is very interesting as an investor, when we looked at some data points, the forward revenue growth, which already penciled into the valuation, at least for next 2 years, is close to 60%. So as an investor, the question is 60% of NVIDIA growth is already there in the market, at least broadly, right? This is not a precise estimate. This is an estimate of a couple of sell side types, but it gives you a good idea. Market already has a view about NVIDIA going to grow at 62%. So the view, if we have to make money out of NVIDIA, right? Let's say 62 is the consensus across all. They need to do an 80 to 90 to 100 to surprise the market and still continue to it. So expectation is significantly higher. As of now, they are firing in all cylinders, no doubt. Very interestingly, price to earning multiple is only 34, but price to book is 27, reflecting they're sweating out of the assets big time. Their ROEs are more than 100. That's where price to book, which typically trades for 5 to 7 to 8 for a great company, NVIDIA at this point in time trading at 27 times. So coming to the numbers, right? This is a TTM large numbers. This is not the quarterly numbers, but what a beautiful picture. A company with a revenue of some $50 billion few years back, gone to 60 billion to 130 billion to 260 billion. And this is as of March and it's 253. What a rise, right? So it's not about somebody has a scale. The scale comes once you have capability. That's what NVIDIA has actually demonstrated. And I'll give you one interesting data point. On a 17 billion revenue, they were doing a close to 4 billion R&D expense, which is close to, or I would say 25% type of money is used for R&D, right? How many companies generally spends at 20-25%? Reflecting this was more of an R&D success story who did the clear work in an area which the market was not looking at. And eventually, when this entire demand came up, they are the only one today servicing a lot. Obviously, few more competitors are coming in. But I think it's a classic case of a large company growing at a significant rate from a 27 billion to close to 270 in a period of 3-4 years is a reasonably unheard of, with an R&D moving from 4 to 21, net income sub 10 billion to 160 billion. So almost they're converting 60-70% of their entire money into net income. And you can clearly see in operating margins, right? These are really sky operating margins at 60-65%. NVIDIA makes an operating gross margin close to 75%, right? So phenomenal company. The operational highlight, this is the last quarter operational highlight. As I told, revenue was 82 billion, grew 85%, phenomenal. The sequential is 20%. It means there is a huge momentum at this point in time. And obviously, right, that's where the stock is reflecting. And this growth is coming from data centers, which grew at a phenomenal 92% rate, 75 billion, and record cash flow. And if you have to look at the outlook is also pretty positive, close to 91 billion. But what we need to understand, from a 20% sequential growth, they are going to move closer to 11 to 12% because on 82, they're going to get into 91 plus or minus, which clearly reflects the sequential momentum will go down, but still a very, very healthy growth, right? With a great gross margin of close to 75%. And the last line, NVIDIA is very confident about doing a 1 trillion of business between the Blackwell and Rubin between 25 and 27. So this is the predominant operational highlights and guidance on NVIDIA. And if you have to look at AI-related talk, which is the topic of the entire market and the key concern which analysts have raised, right? So as an investor, we thought we need to bring these 4 things to you, how the operatingly numbers are performed, what the guidance, so you have a good idea about what to expect out of this company. What they spoke about the AI, which is the buzzword in the entire world at this point in time. And finally, what's a concern? Because as an investor, definitely every company will have something or other. And as an investor, we need to be very mindful if this concern becomes larger and unsolvable, definitely at some point in time, it will have impact on the stock price. So if you have to look at AI, right, clearly the CEO called out agentic AI is arrived, doing productive and valuable work. I think it makes the tokens profitable. It means the money spent on AI, they are telling the productivity is more than that spent, right? So clearly it's a tipping point. Hopefully many corporates is going to use AI to raise a lot of productivity. Second, a lot of partnership got established, like NVIDIA had an Anthropic as a strategic computing partner also. So that gives you what type of direction they are heading towards. And finally, NVIDIA is gaining inference market share rapidly, use the upcoming Vera Rubin platform. Coming to a couple of constraints. One, their consumer softness, edge consumer softness is growing at a subdued rate. But I think the bigger concern, which you need to be aware, sovereignty AI infrastructure demand grew 80%, and our countries are prioritizing to build within the country, right? So clearly, a couple of risks can play out in terms of what type of a chip to be used for which project. So I think every company comes with set of risks, and I think these are the few risks which we thought we'll bring to your highlights. So having spoken about the NVIDIA, the next company is Google. Market cap is 4.36 trillion, beta is 1.27, ROEs are fantastic at 40. Coming to growth, I think this is not like an NVIDIA story. This is a very healthy revenue growth story. So the revenues are growing at 20%, EPS growth at 27. It means market still feels the margins are expected to move further because revenue at 20, at 27, you know there should be a margin expansion. So primarily as an investor, you need to look forward. This margin expansion story should continue. That's what the markets are penciled in. Price to earning is 28 and price to book is close to 9 times. Coming to the numbers again, right? A beautiful number, I would say again, right? A pretty large company from a 215 billion to 400. This is unlike NVIDIA, which was a very subdued to a big size. This was already a big size company 5 years back, today at a $450 billion type of a company, pretty large size. Similar story, R&D grew from 30 to 62 billion. Our net income from 76 to 160 billion and operating margins are very healthy, right? So one story is operating margin in most of the companies in the higher band. This is what I told when I spoke about S&P 500, margin at a high. From here, how much further is the question which as an investor, we need to ask. Coming to operational highlights and guidance for the last quarter, revenue recorded 109 billion, grew at 22%, and constant currency at 19%, 11th consecutive quarter of double-digit revenue growth. In that, primarily Google search has been and other advertisement has been the big driver, 60 billion with 19%. And if you have to see cloud, for the first time, cloud business has crossed 20 billion per quarter, grew at 63%, reflecting the continuous momentum in the cloud business. Coming to guidance, this is on the capex side. The full year capex guidance was raised from 180 to 190. Earlier, they used to guide from 175 to 180. Management confirmed 2027 guidance will be far significant. In this context is where the entire fundraise things are happening in the market. We need to be aware about how companies are raising money, right? You saw 80 billion raises happened out of it, where a company which is producing close to 200 billion of free cash flow, still raising money, reflecting the capex intensity is continuing to go up. So it's a question of so much of money is getting in, and the entire market is today baking in all this capital will bring a lot of productivity. So one of the key risks for all this company today, which is putting a lot more capex, right, on a $200-300 billion is the money has been put and money is putting at a faster rate, and productivities will be seen maybe 4 to 5 years out. So the AI-related talk and the key concern, the AI-related talk is on the Gemini Model 3. So they have commented about Gemini 3.1 Pro was cited as a frontier model for reasoning and multimodal understanding. And first-party model now processing more than 16 billion tokens per minute via direct API, up from 10 billion last quarter. So clear momentum. You can see the cost in the AI search integration is reducing the cost and the spend of the guys. And finally, the efficiency, right? Agentic internal use is being used. Like Alphabet is deploying agentic workflow internally through a program called anti-gravity. Management also cited internal use of Gemini for coding and real estate optimization, a source of ongoing operating efficiency. So clearly, AI is used not only from outside point, internally, which is what the biggest strength of this Max 7 is. They are going to become far more powerful using the AI technology also. This is where, from a competition point, the stronger companies are becoming even more stronger. Coming to a couple of concerns raised, one of the concern which Mr. Sundar Pichai itself acknowledged that Google Cloud revenue could have been much, much higher if there was a little more constraint not there. CapEx depreciation is going to hit a lot because they're putting a lot of money, right? So this will come into P&L and eventually it will put pressure into the P&L. And that's what we need to be aware as an investor, right? The third company I'm going to speak on Meta, which is a much smaller, but obviously it's $1 trillion and part of a Max 7. One of the very interesting question came up to me in the past or a few days back is the Max 7 itself will go for a shuffle or we might have a Mac 10. We are not sure how the nomenclature will happen because with couple of new names which is going to get listed like SpaceX and Anthropic and a couple of other names, clearly we are going to see far more $1 trillion company getting listed. And I'm sure you would have picked up most of these companies will be part of the index in a fast track manner. Nasdaq has changed the rules by 15 days. I think they're going to bring into the index, right? So this Max 7 might not be the same Max 7 for the next season. But at this point in time, Meta is also part of Max 7, 1.5 trillion. ROEs are very, very high. But if you have to look at revenue growth of 23, at least from a penciling point, EPS growth of 10% is what market is penciled in, and a price to earning multiple of close to 22. Coming to the numbers, again, pretty simple. These are well-established, high-scaled, highly profitable company, right? $118 billion company moved to $215 billion. R&D, for a surprise, their R&D expenditure continued to be constant. That's something a very surprising data for me also. Net income grew from 39 to 71 over the last few years. Again, the same story, right? The margins are close to high, right? Clearly reflecting great company, great operating metric. This is on a 5-year basis. Coming to the operational highlight for the quarter, again, the revenue grew at 33% phenomenal. Couple of updates on 3.56 billion people used Meta app, right? A significant number, I would say. It clearly reflects Meta is part of everyone's life. Operating income of 22 billion, representing 41 margin, and ranking improved in Instagram, right? So Instagram, Facebook, Reels. I think everywhere, I think they're doing a phenomenal job. Coming to the outlook, they're guided for a 58 billion to 61 billion. A slight growth. Obviously, there is a growth, but I think quarter-on-quarter growth is going to get a little more subdued. Same story on the capex. Full year capital expenditure, including this one, is going to be 125 to 145, up from 115 to 130. So one of the common theme we are seeing in the Max 7 and many companies, capex is going very large, and these are running into billions and billions of dollars. So as an allocator of capital, one of the worry for us, and we need to be mindful, is this capital is in billions, and it's actually the cumulative is close to trillion. And any productivity mismatch happens, right? I think it will definitely have a serious impact on ROE, and then definitely a tough cycle from overall markets point of view. And one of the thing which they also guided is that employee base will go down, and that I think we've already picked up from the media also. The AI-related talk and the key concern, Meta AI sessions per user increased in double digits. So it means a lot of AI work is happening. Recommendation system upgrade, over 500 million users on each of Facebook and Instagram now watch AI translated videos weekly. And finally, personal super intelligence vision, right? So Mark described Meta long-term goal as delivering personal and business agents to billions of people with agent working continuously towards individual goals across health, shopping, learning, and career. So Meta is taking a slightly different route of having agents for individuals predominantly. If you were to see, a lot more people are looking for enterprise type of a productivity, but I think Meta wants to have more of a personal agent rather than an enterprise type of a agent. Couple of concern, legal, regulatory concern. I think I'm sure we have been going through this, right, from Facebook or a couple of this having anti-clause in multiple countries. Capex return uncertainty. I think Meta has called out that management acknowledged it has unnecessarily underestimated the computing needs, even as capacity has been ramped significantly. No specific 2027 capex guidance was provided because they clearly see they are not able to come to a figure, and always the figure is higher than what they have been thinking. So the message to the market, or at least we want to pass it on, the capex numbers are going to be far, far higher. That's why Alphabet have raised money. I'm sure a lot more people will going to raise money. With money raising spree is happening, which is also not a very positive, right? In terms of, because with so much money, productivity has to come up, as I told. Cost is also rising. Typically today, the memory cost has gone significantly higher. That is what pushing up the entire capex story. The final stock from my side, which is Apple, which is, I would say, it's more of a brand company, but use technology pretty well, pretty large, $4.5 trillion to $4.7 trillion. Beta is actually close to the market, 1.06. ROE is insane, right? We know that it's one of the great company which has one of the best customers across the world. So definitely that should get reflected in ROE. But interestingly, this is also a company which has a stable growth, unlike many of the Max 7, which has a very sharp growth or an erratic growth. So growth of 12%. So you can clearly see a very matured company with the EPS growth of 14, price to earning of 38, and price to book of 43, reflecting the ROE, right? Clearly a very ROE, very asset light, less balance sheet driven business model, driving the price to book. So price to earning will be a right metric, but it reflects how this quality of these companies are in the global scale. As I told the numbers, it's a pretty simple, straightforward, and not a very flashy company. But what interestingly, the $366 billion to 451, but if you have to see R&D, right, in the same time period is close to doubled. So clearly Apple is now putting a lot more money in R&D, which I think can bring a lot more new products or a better product and accelerate either the revenue or the margin. Margin at this point in time itself is very significant. So my expectation is typically revenue should accelerate and sustain. So this is a very good development to see from a forward-looking investor point of view. The net income from 95 billion to 123, and margins are close to high. Again, this is one metric which you would have seen consistently across all the companies, right? The margins are closer to high. So for you, from here to make money, right, the revenue growth is going to be the primary driver. The operating highlights and the guidance. Apple reported again a good numbers, close to 17% record quarter, and iPhone, which is the flagship one, is actually driving, right? So if you have to see from iPhone, which is 2007 onwards, right, this one segment has become the torchbearer, and it continued to be a torchbearer, and it's actually accelerating, right? $57 billion business for a quarter, up 22%, significant. And service business is also all-time high. Service is a significantly high gross margin business than a product business, and that is also growing at a in line with the entire system. And iPhone is doing extremely well. Coming to guidance, Apple guided for 14 to 17% growth, which is a pretty decent, or I would say slightly better than the past. Margins expected to be slightly lower than the current because of the entire input pressure, and primarily because of the memory cost. So one another trend apart from margins all-time high, capex overshooting, the memory cost problem is across a lot of management commentary, and that is where you have seen SY Hynix, a couple of global company which is producing these products have done phenomenally well, right? The conversation on the AI related and the concern, a more personalized series expected to reach users in the late calendar. So that's something which we can all look forward. Mac Mini and Mac Studio are emerging as a preferred platform for agentic AI with the demand outpacing supply. I think clearly they've seen a good success there and a couple of more development. On the concern, I think supply chain constraint is very much real. They have been calling out and they have been telling supply constraint on advanced SoC nodes impacted iPhone and Mac in the March month. Mac Mini and Mac Studio are projected to take several months to reach supply demand imbalance. So clearly, Apple revenues are slightly understated at this point in time, and maybe over once this war gets over, you will see a better productivity coming out of these assets. And again, right, rising memory cost is the biggest headwind which all these companies are facing at this point in time. With this, I think I'll hand over to Mr. Ganesh, my head of product, to take over, and finally I will join for the Q&A. Over to you, Ganesh.
Thank you, Balaji. I think that was a pretty extensive coverage on the first few companies in the Max 7. Now, on to Microsoft, right? No, before we start off with how the companies that I'm going to be covering in this presentation, going into the metrics or into the micros, just to give you a sense of how these three differ from the first four, right? If you look at, let's say, maybe Microsoft will be an exception, but then the companies after that, let's say Tesla and Amazon, they're traditionally very, very different, or rather viewed very differently by the public, while the market views them very differently, and which is why they get the valuations or they trade at the valuations that they trade today. So, which is what we're going to be pretty much covering in the next few slides. To start with Microsoft, it's a pretty straightforward business, right? We all know Microsoft, we all use Microsoft, and whatever they have deserved as the market cap today, which is around 3.27 trillion, is well deserved because they are pretty much a household item today, right? But then they've always been like, for Microsoft to be relevant in today's world, right? It's very evident that they need to be part of the AI race. So which is what we're going to be seeing after briefly looking at their numbers right now. So like if you look at their beta, they're pretty close to the market, and they don't try to diverge so much in terms of price when it comes to the market price. And if you look at the revenue growth, revenue growth and the EPS growth are pretty healthy in terms of forward 2-year revenue and EPS. And the price to book, again, it's not, a metric that you should be measuring Microsoft with. Price to earnings, again, it's a healthy double digit with the kind of growth guidance that they've been given. And obviously, Microsoft deserves that kind of a number. So if you look at their operational metrics, right, for the recent operational metrics on the next slide. So if you look at the total revenue, right, it's if you look at from 2021 to till now, that is March 26, last 12 months, they've pretty much doubled their revenue. And this is a company which predominantly deploys around 10 to 15% of its overall revenue into R&D. And they've been pretty much with it since 2021 till now, right? If you look at around 160, 170 is what they were doing in 2021, while they were spending around 21, is around 10 to 15%, right? Which is what is a similar number as what you're seeing today as well. So as a company, they've grown from strength to strength, and they've become relevant in every other market. And that is what Microsoft usually tries to do, right? Whatever markets that the global cash flows move towards, they try to become relevant towards that. And they've continuously done that. And this is what in today's AI play is what they're trying to do. And obviously with their operating margins getting, we were just having a conversation of how the operating margins are with the Max 7, right? At least with the top 4 to 5 of the Max 7, they're just squeezing every other valuation that they're trying to bring in with their product and squeezing the margins out. And you can see the margins, not saying they're peaking out, but then you can see the chart, right? How they've moved up from 42 to 47%. And that reflects in the net income to the company as well, which is actually doubled in line with what the revenue has done. So they've pretty much maintained their run rate all over. And that's something that we wanted to give you before we move into the specific AI related or operational highlights, right? So if you look at the operational highlights, now Microsoft works with multiple verticals. You can look at cloud is obviously going to be one of the biggest revenue drivers today with Azure and the AI milestone also that they've come in recently. So if you look at the cloud revenue also, there's a very healthy 29% year on year with a 25% in constant currency. And Azure also with basically their cloud services, other cloud services which they are bringing agentic AI also into the picture with, also grew very healthily, very high, around 40%. So these are numbers that in our context, right, that are too high for a big company like Microsoft to grow. So you have already a market capitalization of 3.27 trillion, and your revenues commensurate to that, and you're still growing at 30-40% with your primary drivers of revenue, and that is something that that is not something that you would see every day, right? And that's something that Microsoft has delivered without much of let's say a confusion of what it's trying to do. So if you look at their businesses, is pretty simple. With their AI entry, also with their Copilot expansion, they've done really well. If you look at their 365, Microsoft 365 Copilot, it has been growing for 250% year on year with the seat additions in the last year on year, basically, right? And the guidance also has been pretty decent, or rather decent for if you consider the overall context of Max 7. But then from a very global standpoint, also it's very, very healthy, right? the 2002 Q4 revenue is guided between 86 to 87 billion, around 13 to 15%, which is still decent. While the intelligent cloud is definitely going to grow at beyond 27, 28%, and Azure is top in the pack, which is growing at around 30-40%, right? So if you look at gross margin pressure, what I was saying is predominantly because of the overall hardware inflation that we are seeing around the world, the OEMs have obviously need to push their costs to people like Microsoft who get their revenue from them, right, who are the pre-installed devices. So that is where they're seeing some gross margin pressure, right, which is still healthy at 64%, but still from a year-on-year perspective, there is still some pressure that's going to be there. And with respect to FY27, the growth targets are pretty much healthy, basically. Another year of double-digit revenue and operating income is going to be present for Microsoft, and that's what they've guided. So upon us to, or upon the market to see if the expectations are being met. And if you look at Microsoft's investments into AI and what they're doing into AI, right? If you look at the AI-related talks, you can look at how Microsoft Foundry, right, which is nothing but their model, which incorporates Anthropic and other AI systems or AI models, which to bring in more of their enterprise AI architecture into the picture, that it has actually grown nearly 20% quarter on quarter. But there is a weekly engagement now at the same level as Outlook, which means that Outlook is a brand which has been very it's too entrenched into our lives, right? We use Outlook every day. Everyone who's in a professional setup today uses Outlook almost every day. So when they've done something with Copilot, which is where the engagement of weekly engagement is, which is on a similar level as Outlook, that's something that the market needs to pay attention to. And obviously their agentic coding also, where in the overall AI space where they're present, they're nearly tripling their subscriber base year on year. Again, a very, very healthy growth rate. And their security AI expansion as well is doing really well with customers doubling year on year. And the Copilot interactions as such has been up to 7x over year. So this, you can clearly see that people are warming up to Microsoft's kind of AI, right? Because today, when we open our laptops and when we are in front of our laptops and do our day-to-day life, right, in our professional setup, that is something that we interact with on a daily basis. So Microsoft, in a way, has kind of made anything that has used AI and made it very simple for us to interact with AI the same way that we've been interacting with Microsoft apps over a period of time. So that's what Microsoft has managed to do. And still, I think we believe that there's a long way to go in terms of the AI architecture or AI play that they're getting into. And some concerns, again, there's a supply-demand imbalance, and there's, that is expected to remain constrained at least through the calendar year of 2026 is what they've guided. And obviously, like we spoke about, the memory prices have not been great on Amazon because there's a high teen decline in terms of OEM revenue. And that is definitely hurting them. Maybe in the medium term to long term, that markets will have to see and decide. And the next stock that we're going to be talking about again is going to be very different from the previous 6 stocks that we've been talking about. It's Amazon. And again, Amazon is a household name for a lot of us. And today they trade at 2.75 trillion. And they have a slightly higher beta when you compare it to Microsoft or any Google, let's say. And they definitely have a little bit of volatility when compared to the market. And they're growing at a a healthy ROE of 24%. And if you look at the forward EPS and revenue growth guidance as well, they're pretty healthy on the double-digit terms. In terms of PE, again, which is more of a relevant metric to be tracked with respect to a company like Amazon, it's trading at 30 times, which again is going to be because Amazon has always been a company which has been focusing only on market share, right? They have never, or rather, the business model itself does not concentrate more on the margin expansion. And eventually, that is how they've grown. And market always has seen value in that kind of growth as well. So if you look at the operational highlights, right? If you look at the total revenue, they've been growing pretty well. And if you see their recent growth also, obviously because of, let's say, higher input costs in terms of freight, in terms of because Amazon derives most of its revenue from their e-retail or e-commerce businesses, right? So you can see that it's weighing down on their revenue in the recent. So which is why you don't see them growing as much as the other Max 7 companies have grown for obvious reasons. And their operating margins but then their operating margins have actually become quite better in the recent past, in the last 2-3 years, primarily contributed by efficiency in their operations, which is what Amazon is striving towards, and that is reflecting in the net income to the company also. So the reason why you would have seen that the R&D expenses that we've mentioned on each and every company that we've discussed about, we've put up a chart. So in Amazon, it's a very interesting case why we've not put it up, primarily because Amazon, though in terms of how they report their numbers to SEC, they don't have any R&D expense. But if you look into the numbers specifically, right, there is an expense line item called content and technology, right, which typically consists of their R&D expense as well. So the numbers explicitly won't tell you how much they spent on their R&D, but then if in the next few slides you'll be able to understand what, with respect to their investments into AI and other areas, you'll be able to understand the kind of R&D work that they've been putting their money into. So if you look at their revenue, it's the highest in the company's history, and they've made a record revenue quarter at around 23.9 billion, at a 13.1%, which is the highest in the company's history, right? So if you look at where it is being, which is being contributing to this obviously, Amazon is not going to be just your e-retailer or your e-commerce platform. They have a very solid revenue to contributing item called Amazon Web Services, which has been growing from strength to strength, right? It's been going at 28% year on year, which is the fastest growth rate in about 15 quarters. And which is and if you look at how much they've gone up by 2 billion, which is quarter on quarter, which is their largest Q4 to Q1 increase ever. So definitely they're also growing in strength to strength, more possibly in a different area when you compare it to other AI-led plays. But still, if you look at their AWS also, which is supported with their AI optimization, it is also growing in triple digits year on year. So if you look at what I was saying is in terms of stores unit growth also, where the growth is typically not coming from the AI related play that we've been discussing about all this while, it's still coming from a different side of things, which they've still being grown or still growing at from strength to strength, right? Which is since the highest growth rate since the COVID lockdowns. So, and their advertising revenue also is growing at 22%, which is again a very healthy double digit. So if you look at the guidance, the sales are expected to be around 200 billion, which is still high. And if you look at Amazon, it is interestingly moving into something called the satellite manufacturing launches as well. So, which is moving more into the satellite manufacturing and launches as well. So if you look at Amazon Leo, which is nothing but another AI or another segment that they're entering into, which is with respect to satellite manufacturing, is also in track to become or to get into commercial service to launch in Q3. It's more of an internet service kind of satellite-driven internet service that they're working on. So pretty different from what we have seen in terms of chip making or in terms of AI-related development that we've seen in the previous companies. And in terms of headwinds, there are higher transportation costs because a good amount of their revenue today is coming from the e-commerce business, which again is going to have a higher bearing on their overall transportation costs, which is obviously the problem today with rising oil costs, right? If you look at their involvement into the overall AI landscape, right? If you look at if you look at their Amazon Bedrock growth, which is nothing but their overall AWS services, which is going to be supported with the help of enterprise AI architecture, basically, right? Which is also looking at a very high growth rate, around 170% in terms of customer spend, and they also processed more tokens in Q1 alone than all the previous years combined. So you can see very obviously that there's a lot of traction on that front. And a very big thing is now almost 80% of Fortune 100 companies are now using Bedrock. See, this is something that we have seen Microsoft's slide already as well, right? See, if you see Microsoft, we saw how they became a household name for a lot of us as professionals, which is what is a similar case with what Amazon is also trying to do with their Amazon Bedrock. It's nothing but the enterprise AI architecture that they're trying to bring in to the professionals through their Amazon Bedrock service. And interestingly, while they are on that side, they're also trying to become a little bit of an innovator in terms of chip manufacturing, where you see their Trainium chip, right? Which again started around 2020, 2021. They've gone into Trainium 2 and Trainium 3 today, which is going to be which is going to start shipping from 2026. which is at a much better price performance than Tranium 2, which is nearly fully subscribed already. So you can see Amazon doing these kind of things on this side, while you have Microsoft doing something on the overall customer experience side. Amazon is trying to do something on the customer experience side and also on the hardware side, right? And something on their agent core also, which is their marketing, but their enterprise grade platform for deploying agents, which is going to be more. So the difference between agentic AI and the generative AI is pretty simple, right? Agentic AI will be a little bit more goal-oriented, or rather, it will look at the overall goals in place before taking a call, and it won't be like your generic AI giving you answers for whatever questions or prompts that you give it. And the capex free cash flow. So what Amazon has ideally guided in the medium term, at least, is that there's going to be a outpacing of, there's going to be a near free cash flow pressure, obviously, because of the capex that they've deployed, and they've been pretty open with it, and the market knows it already. And there's obviously going to be memory supply inflation as well, which we saw in the case of Microsoft as well. And the last company that we're going to be looking at in terms of the Max 7 is Tesla. And we're all fans of Tesla for a lot of reasons, right? Whether they make money or create wealth for shareholders. Creating wealth for shareholders is another thing, but then whether they make money for the stakeholders is something that still need to be, they still need to prove it. But then we are fans of Elon Musk for a lot of things in our lives, right? The way he operates and the way he thinks and all that. With that, Tesla has never been a pure automotive company. It is more of a something into the future, right? If you were to put money into the future today, with every other company operating predominantly in the near-term future, Tesla is some company which operates into the very, very far future ahead, which is what is giving its market capitalization today. Because otherwise, you wouldn't give an automaker who is actually not making any money a market cap of around 1.59 trillion. The reason why you give Tesla a market capitalization of this much or a valuation of this much is predominantly because of their ability to look into the future and imagine a future that none of us, as let's say, finite humans, are able to even perceive in our mind. So that is showing up in their numbers, right? At least for now, they're operating at a very low ROE, and their 2-year forward revenue growth in terms of numbers, when you compare it to the Max 7, is also not that great. And if you look at their price to earnings also, it gives you a very distorted number, because what the market typically today gives you a valuation on is more on the forward earnings, in terms of what they're going to achieve in the future, and not predominantly on the historical earnings. It's a prime stock for you to understand how market thinks and how market works and how market rewards and value in terms of like market capitalization. So if you look at the key numbers, like I was saying, they're pretty much low. They've doubled from 2021 to 2026. You can see that the growth has not been nothing, except for the growth from 21 to 22. The growth has not been anything great. And obviously with Elon Musk, who's the primary driver of the entire ecosystem in Tesla, it's basically on his whims and fancies that typically Tesla runs with, and what they are looking for, and the reason why they deserve the valuation today is primarily because of their ability to think far ahead into the future. And this again is the headline number of R&D expense that you see in terms of 7 billion that you see on the screen right now. But then if you look at their other costs, right, let's say employee costs, any other cost that has not been actually classified as R&D, Tesla will not be pretty much making money at all. That is what Tesla essentially is as a company. And it's actually a very different company when you compare it to the other six in the overall Max 7. And that reflects in the operating margins also. They're not someone who cares about making effective money to the stakeholders, but then they've made money through different ways, which is what the market is, through how market has actually understood this company over a period of time and awarded this accordingly, right? So if you look at the operational highlights, though it's predominantly an automaker, their automotive gross margins are still going to be improving from 17.9 to 19.2%, primarily benefiting from the warranty drawdowns and some tariff relief, right? That's where the margin expansion is coming from predominantly. And their Berlin factory, which is the only factory that they have achieved a record output of over 61,000 units in Q1, which is still healthy. But then if you look at their energy storage deployment, right, they've been very clear. There's a sequential decline of 38%. So this full year 2026 deployment will still exceed 2025. So that full. So when you think about Tesla, what do you essentially think about? You think about the future, right? How they're going to essentially improve our lives through meaningful products. So you look at full self-driving or any other self-driving things that Tesla has been in the forefront for. That's what is driving the market towards Tesla today, which is what should be a typical number that we should be looking at. If you look at the overall global customers, they've actually reached around 1.3 million, with growth primarily driven by subscriptions. Right? And their usual capex, they are more like a person who, more like a overall enterprise which keeps spending to move into what is there out there, and they're very ambitious in nature that way, right? If you look at their expanded AI infrastructure or the robot taxi, which is the rage today with respect to Tesla, they are pretty open with their, or rather they usually are open with their guidance, saying the negative cash flow is only going to be expected for the remainder of the year. The same way this time also is the same case. And the revenue timing is going to be as expected with respect to the robot taxi, which is again the rage with respect to Tesla, it's not going to be material in 2026, but is expected to be significant in 2027. Right. And again, the Mega Pack 3 is expected to begin at the end of 2026. But again, this is also going to be a lumpy kind of a business, which is not going to be very value accretive from a pure shareholder when people look at it from a pure shareholder sense. So I think with Tesla, I think it's more like we will only we won't be able to exactly gauge what the future has in with respect to Tesla shareholders or with respect to Tesla. I think even Elon Musk himself doesn't know. It's more of wait and watch kind of a story, but then nevertheless a very exciting story to watch out for. So if you look at their AI related talks and their key concerns, they're trying to figure out how to make Tesla drive vehicles without cellular or Wi-Fi. Now that is something that we cannot even comprehend as common people, right? That is what these guys are working on. And with respect to every other infrastructure in terms of chip production, chip development, or new products, all these are out of our human comprehension, is what I would say. And again, Tesla's it's kind of like a differentiated one in the pack, which is purely always thinking about innovation. And I'm sure the entire company is it's all driven by Elon Musk, but then I'm sure with their kind of experience in the company and with Elon, I think the entire company is still going to be thinking about innovative ways to making the world better. But again, what future has for Tesla is something that we need to wait and see. Because if you look at the key concerns, also the tariff cost pressure or the back data, you have any other concern in mind also that will fit into Tesla's overall ecosystem. But again, the market always looks at what innovation that they're trying to bring in, and what kind of valuation that they're trying to bring to the world, instead of just looking at cash flows or numbers. And I think that is what Tesla as a company teaches us, right? You can be a company with, because there's usually a saying that, you don't need to become, you can have all the capabilities in the world, but then let's say you don't make cash flows, the market is not going to reward you. But then if you look at the US market, they've been continuously telling us that whether you make cash flows today, but I'm always looking at it from a very long-term perspective. And so you show me some capabilities today, or you show me earth-shattering capabilities, and then I will give you the valuation. So in a way, that is something that we have to ideally take from Tesla as a student. Okay, so now we've come to the end of the Max 7 companies story. So this is something that we always wonder, right? See, we see all these companies making so much money. We see all these companies at high margins and high growth. And how is it relevant to us, right? See, unless we know how to create wealth out of all this knowledge that we've gained through reading these numbers, then there's no point, right? So in equity, the main thing for you to achieve an investment success is a combination of these 4 items, right? At least, I mean, there are multiple items, but then from a very structure point of view, these 4 items bring in the entire contours in which you'll have to think at equity. From that perspective is where you need to, that's what you need to deploy to make money or create wealth from equity. The first point is obviously underappreciated growth. So now when we say underappreciated growth, what we need to say is, see, when the growth is already there, when the growth is already appreciated, when growth is already visible, chances are that your investment is not going to yield a lot of fruit probably it'll do because of momentum or in the near term. But then let's say the growth is already well known to the people, well known to everyone who's investing with you. Chances are that your investment success will be very limited because the crowd is already there inside, right? Which is what is going to take us to the next step, which is cheap valuations. So when do you get something cheap, right? When nobody wants it, when there's pretty much there's not a lot of activity around a specific asset, whatever the asset might be that, right? So that is when you get an asset at a very cheap valuation, which is again less crowded, right? Like it is somehow linked to the first point also, which is underappreciated growth. So whenever there is a temporary phase, now this doesn't mean that we should chase companies with growth which is low, or rather this is going to be something which is underappreciated growth. Typically means those companies which are going through, let's say, a temporary phase of growth slowdown, or rather this growth is not being looked at by an investor very keenly. That is where your equity investment success typically comes in, and that is mostly a case where these kind of ideas are less crowded because nobody wants to touch them. And final is again where this is going to come from is the less supply of similar securities. So let's say there is a similar. So when you say less supply, what it exactly means is that not everybody is willing to participate in this idea today. So you don't ideally get a lot of you don't ideally get a lot of supply of those similar securities today. So just to give you a sense of how this will work, I would want to look at how AI stocks are into if you bring this structure into AI stocks today, right? Let's see how if they actually fit into at least one of these contours or one of these structures. So if you believe that even one of these structures are somehow connected to the AI stocks today, I think there is definitely some merit to be looking at it. But then if you look at AI stocks today, there's the discovery of growth is very, very well discovered today. There's no point in talking about AI because everyone knows that the growth is going to be there at least for the next 2 years. But the only thing is that with this, post 2027 or 2028, will this sustain? But then at least for the next 2 years, the discovery on growth is pretty well discovered. Right? And today, with the valuations with these stocks or any AI-related companies trading at, you can see that the valuations are very sky high. Right? For any market investor in the markets, it's going to be pretty apparent that they are not buying today at a valuation that is conducive because the growth is already priced in, like we said. When these kind of assets come into the market and they show growth, right? Let's say for a couple of quarters, which are sustainable, sustained growth for a couple of quarters, market gives the valuations which are pretty high, which make the next investor who looks at margin of safety tough to get in, right? So that is where we look at AI stocks today. And if you look at the crowd, obviously everyone is into AI today. Everyone wants to buy AI today. There's a lot of crowd in it, right? It is not definitely not a less crowded space, it's an overcrowded space in the contrary. And definitely because there's a lot of attention to it today. And if you look at the last point, right, which is something that I want to explain, which is more of lots of new supply, right? Today, we were just discussing a case where, Balaji also mentioned the SpaceX IPO, which is coming up in the next week, right? If you look at Fidelity, they have created a situation where if you have a broking account and a 2000 and have $2,000 in that account, you will still be able to be participating in the largest IPO in the world, right? So all this points to just one thing, right? People want to ensure that they want to get into the overall equity bandwagon, the overall equity rush that this AI play has gotten into. So you're going to see a lot more supply and a lot more time and a lot more people getting into this overall AI play as a story. So this is what we need to look at in terms of how to create wealth and equity, right? So in our experience, it's if you are more into the second bucket, you probably might make money in the near term or the medium term, but most of the time, what we have seen in our experience is this kind of money is mostly fungible because what you're getting into typically is not at a great time because your people are, let's say, already blown these valuations out of proportion for which you can reasonably make some money with a good margin of safety. And this is another structure or thinking that we usually deploy to see which kind of asset to navigate, how to navigate between assets to improve your portfolio. So if you look at the different markets that have grown significantly well in the last 18 months, right? See US, Taiwan, and Korea, they're through the roof, right? Because of the overall, because they've, all credit to them because they saw something, the huge tailwinds coming into a specific sector and a specific idea, and they place themselves right in that place, and their returns or the way the money that they made over the last 18 months is for everyone to see, right? So today, why these assets made money is also very simple. It's because of a great profit growth in the past, and there is a strong story, which is what your strong past returns are also showing today. So in these kind of assets, as asset allocators, what we typically say is that these are potential assets where you need to reduce your allocation to, right? Because most of the time, all these assets are, like I said, most of these stories are already priced in because your profit growth is more in the past. Where equity markets are always ahead of us in terms of pricing in all these kind of stories, and for us to be at the safer end of the curve, or rather to ensure our margin of safety, it is important to deploy this kind of a thinking to improve our portfolio outcome. So now, let's say you reduce your potential deductible asset like a US or a Taiwan or a Korean exposure. Where do we invest, right? There's again a potential buy asset that comes into the picture in this case. If you see the last 18, 20 months, India would be the poorest performer, right, in terms of global markets or emerging economies. It has been the most poor. And for the right reasons as well, because the profit growth in comparison to what the other companies and other economies are growing at is pittance, right? And obviously, for the right reasons, is what we've been underperforming for the last 18, 20 months. And obviously, market is usually enthused by something that is some story that is there for the short term. So if you look at story in terms of India, there's nothing for the short term. There's actually bad news only for the short term. But then, as asset allocators, we've always seen that when you take uncomfortable bets during uncomfortable times, right, that's when you win. So that is something that we always follow before we decide on whether we need to do some asset navigation before, because all at the end of the day we need to make returns, right? We need to make money over a period of time, and with these kind of asset navigations, these will be uncomfortable decisions today, but then they need to be done for us to maintain that return expectations that we have now. And this is something again we look at if you have a change in your business model, right? They need to have a reset in the valuation model also. What this chart typically shows you is that the analyst estimates for the next 4 quarter free cash flows, right? If you look at, let's say, Microsoft, Amazon, Google, or Meta, Oracle, and their combined free cash flow, right? Free cash flows are nothing but the cash flows that the business generates on a forward basis, free cash flow for the next 4 quarter. So in this case, if you look at all these top guns, right, the combined free cash flows going below. These are the analyst estimates, and obviously more often than not, they're pretty much in line with the estimates. And if you look at what they're expecting in terms of the next 4 quarters, you can see that the chart is imploding down, right? Primarily because of the AI-led capex that they have done across the board. So in a way, this AI-led expansion or the AI-led capex might work out in the future, but then there is nothing to take away the fact that in the next 4 quarters there is going to be some bearing on their combined free cash flow. So that is something that market needs to factor in today. And probably market is very enthused today because of the growth or the terminal growth or the TAM or the total addressable market that is being expanded towards AI-related plays today. And that is why market is giving these AI-related plays a lot of valuation. And obviously, when euphoria sets in, numbers take a backseat, right? But again, as asset allocators, we always need to keep a very steady mind and see whether your asset allocation is in the right place with respect to, because euphoric markets are global. Euphoria can be global. It doesn't need to be restricted only to India. We have seen euphoria in global markets so many times previously, right? Just if you see in the next slide also, your starting valuations definitely matter. We have seen 2000 bubble, the dot-com bubble, and how the stocks went up through the roof when the dot-com bubble came in. So from India, we would be pretty privy to whatever happened in 2023-24, right? The kind of euphoria that had set in with small caps. But then we rarely think that the global euphoria can also be as much or even higher. That's how the 2000 dot-com bubble can be. And another question is that, these are all biggies, and obviously they're putting in money where they believe growth is going to come from. But the overall market, the global market, which is pumping money into the markets, into Nasdaq or S&P 500 today, doesn't need to necessarily believe that because more often than not, market thinks in terms of short term or medium, 6 to 12 months. And global markets are also not someone who's averse to that kind of thinking. So every euphoria is something that can set in even in the global front is what something that we need to keep in mind before we take a valuation call. And to summarize the entire presentation, right, the US economy's cycle is good, the corporate cycle is good. The only thing we would say as asset allocators is that always, I mean, this doesn't relate just to AI or the recent play. It's more like you have to moderate your portfolio risks, right? So there's a very profound statement which says, diversification is the humility applied to uncertainty. So when there's uncertainty in where this is going to lead to, obviously it's very easy for us to get carried away with a lot of energy and a lot of growth. But then when you apply a little bit of your humility today, that is when you see that diversification is very, very important in terms of, because we're not saying totally stay away from AI as a play also. Definitely there's a lot of merit to it. Otherwise, the globe itself wouldn't be pivoting itself towards it. But then we've seen periods of euphoria like this. And diversification at this point of time is definitely a more humble response to what has actually transpired in the last 18 months. And the euphoric markets always give us a window to preserve and grow our wealth that we have seen time and again. And as usual, sales driver will be a bigger driver of value going forward. So whoever captures a bigger pie of the overall global cash flow is going to be more relevant in today's world. And finally, to end with it, we believe risk to reward, right? As we always say, as people who are fundamental investors, they always look at risk to reward is definitely favorable in terms of longer and diversified growth markets like India with reasonable valuations. So with that, I would like to end the presentation. And Balaji, if you have any closing notes, we can end with that before we move on to the question and answer session.
Yeah, thanks, Ganesh. I think to end with, I think US market at this point in time is doing extremely well. But as we alluded, right, as an investor, it's not about what we know, how we think about investing today to take money. And as Ganesh told, right, we need to be a little more apply the humility and be a little more humble and be a little more diversified. I would say the AI trade is getting stronger. Most of our portfolios are getting concentrated to few ideas and few themes. And as I always say, right, risk comes from the place which we generally don't see. So we generally wish, and as an asset allocator, right, little more diversified, both on the markets, on the segment, so that having made the money, we need to protect and grow. And that's how we think about, and that's where we thought we will talk about this S&P 500 and Max 7. Thanks for joining, and we'll be very happy to take any questions from a broad thinking point or anything which you think which will help you to take good informed decision. We'll be very happy.
Yes, sir. So we have a question in chat box. So Mr. Raj Tata have a basic question like, why did you spend 90% of the session on the US stocks only to say that actually now you shouldn't invest in US, focus on India?
Okay, sir, I think it's not about not to invest in US. I think your question is valid. One, the idea behind the session is to educate on how well US has been doing. And if you're over allocated to US, it's a time to reduce it. It's not about saying be zero. So if let's say as an investor, if you have zero exposure to US, I would say anytime is a good time to start taking exposure to one of the best market. But if you are a US investor who have a 90 to 100% in US, maybe this is a very good time to think about having made the money. How do I reallocate? Not necessarily in India, if you find any other market which is also attractive. The whole idea is take stock of things, see the data as it is, and then if needed, you reallocate. So that's the whole idea about it. Rather than taking a very specific window of the entire content is on the maximum, they have done well. So you need to definitely give merit to them. But obviously, it's a late stage market, right? To give you a context, in the last few years, the markets have gone up 100%, right, from the overall S&P. So we thought it's very important time to talk about the risk in the market. And if you're overexposed, maybe slight reduction from an overvalued asset to a cheap asset is what generally our way of investing. And that's what we thought we will share it to you.
So, yes, sir. There's another question. So Mr. Palavasam is asking like whether to sell in Max 7 and invest in India.
I think it's a good question, sir. But the whole idea again is it's all about the mix. I would never say, see, Max 7 is a great story or S&P 500 is doing really well, right? The numbers are backing. The question to ask is how much exposure do you have and what you want out of the market in next 3 to 4 years, right? If you think you're overexposed to the market, you've made money, you want to reduce risk, I think the starting point is very good. My only suggestion is maybe we can obviously connect post the meeting also, then talk about what is your risk profile, what you want out of India market. But broadly, the thinking is to talk about the numbers and how are they positioned, what the investor should expect. And if you're overexposed from a overvalued asset, you generally tend to reduce and you can expose to a cheaper asset. So that's how I think about. But I think your thinking is appropriate. But I don't know how much you are exposed to US market and how much on India and what you want out of India. But I think at a broad level, US is been going through a good time. And definitely Indian markets for the last 24 months has been not going through a great time. So it could be a possible switch, but I think we need to evaluate case to case basis.
Yes, sir. Another question, Mr. Sadeep. So he's asking like better international fund to invest for diversification is China Axum. So
I
what is
think
the-
I think you need to be a little sure about what type of a market you get exposed. Definitely, China is one a very puzzled market, does extremely well in pockets, but if you take a long stretch of 10, 20 years, right, they have done only pockets of performance and then you don't see them performing from a capital market point of view. But as an investor, if you have a decent balance sheet out of India, one thing I definitely encourage, not tomorrow morning, but over a period, you should definitely diversify outside India because there are great companies is built out of India, outside India also, right? So I think international investing is very much encouraged. It's all about where do you choose. Today, at this point in time, from FPS assets point of view, we are not deploying a lot of capital in Chinese market. So that's where our view is at this point in time. But we keep evaluating our thinking, our data, incoming data. Because if you see, DeepSeek is raising capital close to $7 to $8 billion. So suddenly there will be some definite AI trade will happen out of China also. But I think in the past, these trades have been very, very shallow. It means very tactical trade. You have to go in right time. You have to come out in right time. So for us, broadly, we look for countries and the segments which are durable, which can give us a 3 to 4 year type of an outlook. So at this point in time, we are not allocating any capital, but we continue to monitor as a team. We have a 7-member strong investment team from FPS Assets doing entire work both on the mutual fund SIF and the global and the GIFT City. But at this point in time, we are not allocating anything into Chinese market. Hope I answered your question, Mr. Sandeep.
Thank you, sir. There's another question. How about same from Mr. Palavisan, sir. So how about current scenario in Taiwan and Chinese tech stocks? And he also asked, like, should we keep 80% in India and 20% in Max 7? So
I think Taiwan is definitely a played out story. I mean, if you like to take a running train which is going at 120, I leave that to it. So we, being a fundamental based investor, we look for what? We look for cheap asset, not an overcrowded trade. On the medium term, the risk to reward is favorable. And I'll tell you what is risk to reward from us is, first, I want to take care of the downside. So when we allocate capital, we want to be very, very clear. The downside has to be limited because if the downside is too much high, right, I think the stress levels and the volatility, a lot of investors can't take. So we want to protect the downside and grow up. I think Taiwan having performed big time in the last few years, definitely at this point in time, we are not a buy. And we don't have big exposure, but definitely it's a good time to think about the known, the markets have performed well. Maybe you need to think about, if at all, to reduce, this could be a good time, right? You need to think hard. What is something which you are more excited than what the market is today, not aware of it. As such, Chinese, I think I've already responded. Coming to your combination, yes, I think 80-20 is a great combo, I would say, right? Being a part of an India, I'm also a little more tilted towards India. India is a long growth economy, but an average growth. So India typically end up doing between 12 to 14 on an average, right? So we are not going to have a very spurts of a growth because we don't participate in the space tech or an AI type of a story. Globally, definitely you can play. So a good combo of India, global various country makes a lot of sense. And I think 80-20 is a great combo to have. I think that's a fantastic setup, right?
Thank you, sir. There's also another question. So, Mr. Raj Datta thanks you, and he says like is mostly done through ETFs like SMH and RAM, which allows him to diversify within AI basket. So, similarly, is there any other global ETF you advise?
Okay, so I think we have not done any deep work on the global ETF. I do track a lot of ETF on single securities, and a lot of innovation keep coming up. I think at a broad level, we clearly see there are two mega waves: AI related energy, all that is happening, as you rightly told, memory, all. There is this GLP-1 drug, right? That is also a mega wave. Obviously, you need to choose between what you want. But I think at this point in time, we are predominantly an India focused guys, but have some idea about what's happening in the world. We are obviously expanding our team to have a greater perspective on global ETF all. Maybe we will do some other time a separate session itself on the global ETF. But I think maybe we are not the right person to give you any type of a thinking on how to play on this using a global ETF site, right?
Thank you, sir. Question from Mr. Arun. So, in India, considering current situations, which sectors are all looking attractive? In US and Taiwan investments, are you asking to book profits now?
I think, Arun, thanks for the question. I think overall, our view is some of the markets are getting very expensive. We are aware, right? There is a definitely data we have shared, how Max 7 has already performed. The margins are all-time high. The multiples are all-time high, right? So when you have margin at all-time high and multiple all-time high, the only lever is sales growth. So I think if you're overexposed to global market, maybe there's a good time to see, not to sell out fully, right? That doesn't make any sense at all. But you always sell an overvalued asset. You always move capital from overvalued to a reasonably undervalued. And the framework which I think Ganesh has shared, right? What is undervalued for us is long durable growth should be there, performed poorly in the near term, and there is no story. And if I fit this three, right, one of the market to think about is India, right? Because the same India 2 years back, September 2024, it was the most hottest market. Everything was flying in. And what we saw is 18 months, everything went, right? So market change opinion. And I'll give you one data, Arun, for you to think why global markets also can change opinion is, I was just looking at Bitcoin, which is down close to 50%, right? From 120 to 60,000. And this has happened in the last 9 months. It means by last September, we were at 120, and today by June, we are at 60. It means it all takes a year at time for the market to change opinion or fall by 50%. So as an allocator of a capital from FPS, we are very clear. We consistently ask our investor and ourselves move from a overvalued asset slowly, not aggressively, slowly. I'm very repeating it, and then move it to an undervalued asset. So I think it fits in well. India has not done well, so we clearly see pockets of Indian markets are getting very cheap, and you have seen FIS selling has been relentless for last 18 months, right? So a lot of large cap funds and few flexi cap funds. So we predominantly deal with mutual fund, PMS. We are amphorealistic listed mutual fund distributor, PMS distributor, and SIP distributor. So we use various flexi cap mutual funds, index funds to construct portfolio. We don't take big sectoral call, but primarily we see next 2 years the earnings growth is going to come a little better from a single digit to double digit in India, driven by banking. Because if you have seen credit growth already moved from 10% to 16%. And with rate cycle now not going downward, the NIM pressure is going to go away. So I think banks are going to lead the growth, well supported by auto and pharma, a bit of FMCG. And I think maybe next 1 year they'll do well because of this currency. But I think over a long period, they are structurally a 7-8% EPS growth sector. So I think this is how the broad construct. And if you move beyond 100, the growth is actually happening, right? Due to a lot of infrastructure, a lot of companies have completed CapEx. We have seen a lot of good numbers coming out of export-related company who is breaking through their 5-year cycle. So I think the opportunity set is there, but definitely it's not the most exciting market today because we are delivering a 12-13% earnings growth against S&P today doing a 25-30%, and Taiwan is doing upward of 80-90%. But all this growth is now penciled in into the valuation, right? What you need to ask is beyond this, who is going to grow? I think India is a little more longer story. We have a great balance sheet both on banking and the corporate. So we clearly believe who is coming on a 5 to 7 year outlook with a very moderate return expectation of 12 to 13. India has always delivered. And I think it could be one good market if you are underexposed.
Thank you, sir. There's another question. What is the outlook on US small cap or Russell 2000? Isn't it reasonably valued? Will there be continued rate hike in the US to control the US debt?
So I think the smaller companies have a little better scope because they have not had a rally like what we have seen in the Mega 7 on the AI related. But definitely US stuff has gone through upcycle. So maybe a slow way to accumulate capital that make a lot of sense. Coming to rate hike, I think definitely from a rate cut to rate hike is being thought about. And if you see yesterday, right, US markets fell sharply close to 4%. Your gold fell, your Bitcoin fell. Almost every asset in the world has fell because of there is a clear view. They had a strong job data in US. So the view is very clear from a rate cut. We are in for a rate neutral to rate hike type of a thinking. And that is where the market is reassessing. And if you look at gold, right, from FPLs, we're very, very proud to share. We gave a sell call or a reduce call at $4,400 9 months back when gold hit the first time and then went to 5,400. But now if you have to see today, right, it has come back to 4.4. So we clearly see the euphoric phase can go a little longer, but the moment you know the asset gets overvalued, it's always good to reduce. I think US interest rates are not going down. The world interest rates are actually going up, right? You can refer by any 10-year GSEC has actually gone up. So I think we are in for a slightly higher rates. And definitely this war is the biggest catalyst there. Hope I answered your question, sir.
Yes,
should we keep 80-20? That's answered. Will the Magnificent Seven no longer?
That I read. So, question from Badri Narayanan. Yeah. So, with the Magnificent Seven no longer moving as a single trade, how should I categorize these companies between high stakes execution bets, AI growth leaders, and defensive anchors to properly manage risk in 2026?
Badri, I think as Ganesh told, right, all these names are not very common, right? If you take Tesla, right, it's like a SpaceX, obviously coming from Elon Musk, right? You talk a 100-year view and take a view. And if you take an Apple, right, a very clean, simple product-based company doing phenomenal job. Even in China, they have done a phenomenal job, right? So you have a company which is client-facing, you have a company which is enterprise-facing, and you have a company all over, right? So that's how you need to distinguish it. Definitely, one thing is most of the Max 7s are big in balance sheet, big in free cash flow, except Tesla type of an ideas. But they are significantly investing. One of the statement which NVIDIA chairman told, the entire aggregate AI capex in next year will be close to $1 trillion. So I think we need to differentiate based on how they're capturing the cash flow and then accordingly position yourself. I think we'll quickly see in the past.
The last question, sir. Mr. Pagalaisen. So what's your view on Taiwan and South Korean market caps crossed Indian market cap? Will this sustain or India will bounce back and overcome this?
I think we don't have to take a view for tomorrow, but I think in the medium term, India has done well, right? So I was looking at a 25-year USD-led performance of how markets have done. So India has delivered 8 to 9% USD return for 25-year period. US has done close to 10 to 11, I told, right? And Taiwan, Korea, all these people have done between 6 to 7. So if you take a 25-year track record, India's done phenomenally well. But I think the last 5 years has been a little more challenged. And I think last 2 years definitely challenged because of AI trade. So as an allocator, right, India is one of the long trade. We continue to be very, very positive. So it's not about India versus non-India. It's all about the combo. But today at this point in time, if I have to choose one of the country, right, not the only country, one of the market, which I clearly see, which is a long growth, no story, assets are reasonably priced in pockets. India is also not cheap across the board. Definitely, I would consider Indian markets is worth considering. And to add the last point, the currency, which has moved from 85 to 95, and today we have seen RBI policy yesterday, which is definitely trying to bring a lot of FCNR deposit. So there is a rough estimate of close to $40-50 billion of a deposit has to come back, which can solve our CAD issues and BOP issue. So clearly with currency now depreciated and a little more cheaper on real terms and EPS growth of 12-13%, I think we are stage set to deliver reasonable return in the medium term. Sorry. Thanks, Ganesh, for your feedback. So we on IT. I think
so there's one more last question.
Okay.
from Mr. Sadeep. So, what's your view on IT from India perspective? I mean, prospect.
I think IT will be a trade. Definitely, it's cheap at this point in time. We don't have any sectoral view on there, but it is going to be a trade with a 7 to 8% EPS growth. Indian nominal GDP is 10 to 12, right? So you don't have to buy into sector for long term like an IT. But definitely at this point in time, it's very cheap. So we have few funds exposed where they are more exposed to IT today at this point in time. But otherwise, we're not big bull in IT.
Okay, so there's one more question from Mr. Vinod. Is there any view on AI bubble? What are we seeing in AI bubble will consistently do well in future?
Thank you, Vinod. I think this will end. It's a good question. We don't want to say what is AI bubble. Bubble means simple. There is an element of truth and there is a lot of froth. That's how we have to think. The story will be very strong. The past performance will be wow. So take Bitcoin. A year back 120, today 60, right? Now you can say 60 can become 2 lakh 40, but 50% drawdown, right? Bubble is all about, there is definitely element of truth. This is where the concern is the AI is real, 100% real, right? We are all spending money. I was talking to Ganesh, the amount of dollars we are spending as an FPS assets to use technology from our research point and the fund management point all. But the whole idea is AI, how much value, right? You can't have trillion and trillion. And I'm sure if you have seen SpaceX DHRP, right? They're talking about $30 trillion of a TAM, which we can't even envisage, right? So the whole idea is AI, definitely an element of AI in our view is overvalued as an element of bubble, but bubble is only known after it gets burst. We clearly watching it and seeing there is money has been made, and you have made actually 10-year money in 1 year, right? People have made 8x, 10x in some of the AI ideas in 1 year. I think now don't ask, is there a bubble? Definitely there is euphoria. Let's not confuse ourselves. The question is how to make the best use of the bubble, make the money, preserve the wealth, grow the wealth. That's the game in town. I think I'll leave that to a best of your judgment. I've given you the framework, your strong past return, strong story, high valuation. All three leads to closer to bubble. And it's up to you to apply it and see whether any of this trade fits there. In our view, I think there is definitely an element of higher euphoric in this space. Thank you. I think with this, I think we have taken a lot of your time. Thanks for joining and hope we added a bit of value to you and wish you a great investing. Preserve your wealth, grow your wealth, and we'll be very happy to connect. And if you can add value, we'll be very happy to serve you. Thank you.